So just an outline of what I'll be discussing tonight. First of all, the cost-based reset under the transfer balance cap regime, dealing with the transfer balance cap post 1 July 2017, what to do with transition to retirement income streams post 1 July 2017, and making non-concessional contributions pre and post 1 July. So in order to access the cost-based reset, a fund must satisfy a few preconditions. So the first is the fund must be in pension phase. So this doesn't mean the fund has to be 100% in pension phase. It can be in part or in full. And it also includes those funds that have TRISs in place. So if you've got a fund that's only in accumulation phase, they can't access the cost-based reset. The asset that you're seeking to apply the relief to must have been held prior to 9 November 2016. And the fund trustee must make an election to choose the relief. So it's not automatic, and I'll be discussing a bit later about making an election. So how does the cost-based reset work? It works on an asset-by-asset basis. So a fund trustee can elect to reset all of the assets of the fund, some assets of the fund, or no assets of the fund. And the elected asset is deemed to be sold on 30 June 2017 at market value and immediately reacquired at that price. So this effectively resets the cost base of the asset to market value as at 30 June. It's important to note that the 12-month holding period for the 1/3 CGT discount will start again. So in some circumstances, it may be that the CGT discount will be more beneficial than the cost-based reset. And so this may be where you've got an asset that the fund would likely sell within 12 months from 1 July 2017. So the way the cost-based reset works under the segregated method and the proportionate method operates quite differently. I know that the segregation method can't be used from 1 July if one member has a balance of more than 1.6 million and that fund is paying a pension. So it's important to note that in relation to the 1.6 million, that's across all funds. So it's not just on a per SMSF basis. So as soon as they've got 1.6 across more than one fund, you're out. And as soon as one member has more than 1.6, even if the other members of the fund have less than that amount, the fund can't use the segregation method. So in order for the cost-based reset to apply to an asset under the segregated method, that asset must actually cease to be segregated before 1 July 2017. So an example of doing this would be to partially commute the pension back to 1.6 and the balance would go to accumulation account. So this can actually be problematic where you've got a fund that's 100% in pension phase, but no member has more than 1.6 million. So you don't actually have to do anything as at 30 June, but you will have to if you want to access a cost-based reset. So one way of getting around this would be you need to take the asset out of segregation so the member can make a further contribution, or the pension is partially commuted back to accumulation account. Again, the SMSF trustee can choose to apply this to all assets or just some of the assets, and any capital gain that arises from electing to use the relief will be 100% tax-free. So unlike segregated method, under the proportionate method, no additional steps are required to access the cost-based reset. And any capital gain that arises from applying the relief in these circumstances is tax-free, but only to the proportion that the fund is in pension phase. So this means that a capital gain will be triggered for the proportion of the fund that's in the accumulation phase. And there are two options for dealing with the payment of a capital gain in these situations. One is to pay the tax in the 2017 year, or defer the notional tax on the assets until they're sold at a later date. So an example of how this would work, this example talks about paying the tax in the 2017 year. So let's say we've got an SMSF and it holds assets of $3 million and 2 million of those assets are in pension phase, so you're 2/3 in pension phase. The cost base of the assets is $600,000 and all assets are held for 12 months or more. The SMSF trustee chooses to apply the relief to all the assets of the fund. So on this basis, on 30 June 2017, the SMSF is deemed to make a capital gain of $800,000. This is calculated by 1/3 of the value of the assets, being 1 million, less 1/3 of the cost base of the assets, being 200,000. And that 1/3 is relevant to the proportion of the fund in accumulation account. The SMSF will then pay the $80,000 of tax in the 2017 year, but will hold assets with a cost base of $3 million. So looking at it from the other way, if you choose to defer the notional tax on the assets until they're later sold, again, SMSF has $3 million of assets, 2 million of those are in pension phase, but this includes real estate assets worth 2.1 million, and the cost base of that asset is 600,000. So on 30 June 2017, the SMSF is deemed to make a notional capital gain of 500,000. Again, calculated 1/3 of the $2.1 million market value, less 1/3 of the $600,000 cost base. The SMSF then later sells the real estate 5 years later for a price of 4.1 million when it's 50% in pension phase. So then it makes a taxable capital gain of 1 million with capital gains tax payable of $100,000. So again, calculated by $4.1 million sale price, less $2.1 million new cost base, times 50% in accumulation account. And in addition, it must bring to account the notional capital gain that was triggered back in 30 June 2017. So it results in a total capital gains tax payable of $150,000. Making the election. So as I said before, the election isn't automatic. The fund trustee must actually make the election in order to utilise the cost-based reset. And the election must be made by the time the fund is due to lodge its 2017 tax return. So it's really important to note that it's required, the election must be made by the time the fund is required to lodge its tax return, not when it actually does lodge its tax return. And the ATO have made some comments that the election is likely to be contained in the capital gains schedule of the tax return. It's not confirmed yet, but still a bit of a watch this space area, but that's where it's likely to be contained. When would you consider not using the cost-based reset? So firstly, where you've got where the election will result in a capital loss, you wouldn't do this. And secondly, where you've got an SMSF using the proportionate method, and you've got a second member that will shortly come into pension phase. So an example of this would be, let's say at 30 June, you've got an SMSF and it's 40% in pension phase. But shortly after, the second member of the fund is expected to come into pension phase. And when they do, the fund will be 80% in pension phase. So in an example like that, you may choose to not utilise the cost-based reset then. There's a known issue with using the cost-based reset where it applies to units and shares. This is because the cost-based reset applies to assets held by the fund. And in these situations, the assets held by the fund are the units or shares in the unit trust or company, and not the underlying asset held by the unit trust or company. So this can cause a problem where later on the underlying asset is sold rather than the units or shares themselves. This won't necessarily be an issue if the property will be kept and the units will later be transferred out as a death benefit, or where you can wind up the unit trust when the asset is sold. So example, it's a one asset unit trust. So an example to help illustrate this, let's say we've got an SMSF and it holds units with a cost base of 500,000 and a market value of 2.5 mil. The unit trust also owns property with a cost base of 500,000 and a market value of 2.5. The SMSF elects to receive a cost base reset for its units. So the cost base of the units is now 2.5 million. The unit trust later sells the property for 3.5 million, so it makes a capital gain of $3 million, being 3.5 sale price less a $500,000 cost base. So at that time, if the SMSF is in pension phase, it will pay capital gains tax of $150,000, being the $3 million capital gain times 50% in accumulation phase times 10% of the SMSF CGT rate. The unit trust is later wound up, and at that time the SMSF would receive a capital loss of 2.5 million. So in these situations, you could consider restructuring prior to 30 June 2017. However, you will need to factor into account any potential duty that may arise from a restructure. Or consider whether the unit trust can be wound up in the same year that the asset is sold. This is because any capital gain that may arise from the sale of the asset can be offset against any capital loss that arises from the winding up of the unit trust in the same year. So both the explanatory memorandum to the new legislation and the ATO both note that Part 4A may apply to schemes that are deliberately designed to maximise a cost-based reset. So An example of this, it's quite a drastic example, but let's say in order to bring an asset out of the segregated method, a $1 contribution or commutation was made into an accumulation account. So in an example like that, the ATO would potentially seek to apply Part 4A. So a common question that's asked is whether segregation can still occur post 30 June 2017. So one way of dealing with this is using multiple SMSFs. So you'll have one SMSF that's fully in pension phase and one SMSF that will be in accumulation phase. So an example there, let's say you've got an SMSF with an account balance of $2 million and it's made up of $1.6 million of real property and shares and $400,000 of cash. So you'd have the one SMSF holding the $1.6 million of real property and shares, and that would be 100% in pension phase. And then you'd have the other SMSF holding your cash, which is in accumulation phase. So the aim would be to keep those assets that are likely to yield a higher return in your pension account, because as Phil said, any returns don't affect your transfer balance cap. Therefore, those assets with expected lower returns should try to be kept in an accumulation account. Another thing to keep in mind with your pension account is where you've got a pension account that holds largely illiquid assets, you just need to be able to still make the minimum pension payments. So just make sure there's enough liquidity there for that. Speaking of minimum pension payments, ensure that only the minimum are made from the pension account. So any additional funds that are required to be taken, let's say the member needs further funds, these should be taken from either the accumulation account or as a partial commutation of the pension. Transition to retirement income streams won't be abolished as of 1 July 2017. However, they no longer qualify for pension phase. So this means that any assets that are supporting TRISs as at 1 July will be taxed at 15% on income and 10% on capital gains for those assets that are held for at least 12 months. So therefore, the only reason a member would have a TRIS in place going forward is so they can access benefits before meeting a full condition of release. Eligible TRISs could be converted to an account-based pension, provided that member has met a full condition of release. Now, it's questionable whether a TRIS can auto-convert into an account-based pension. Also, again, provided that the member has met a full condition of release, you just have to look at the documentation. So you'll have to have a look at the pension agreement that put the TRIS in place and see whether it's got the ability to auto-convert into a pension. Otherwise, you'll need to do resolutions to do that. Non-concessional contribution. So it's the last chance for those members with a total super balance, so not transfer balance cap, total super balance of greater than 1.6 to make non-concessional contributions prior to 1 July. Such members going forward will only be able to make future non-concessionals if their balance drops below the limit at the previous 30 June. And this is a rolling test, so it's tested each and every year. It's also the last chance to take advantage of the current caps. So currently 180 per year or 540 under the bring forward rule. So it's a really good opportunity at the moment to move property into super, because let's say, for example, you've got a husband and wife SMSF, they can both utilise the bring forward rule. They can bring across property just worth just over $1 million. So it's a really good opportunity to do that. How to take advantage of non-concessionals pre-1 July. If members have cash, roll that in, or as I said, transfer real estate from individuals or trusts to SMSFs. And there are duty concessions for doing that. So as of 1 July, the non-concessional caps dropped to $100,000 a year or $300 under the bring forward rule. So using the same example as before, where you've got a husband and wife SMSF, they can only bring forward collectively $600,000. So it makes it quite difficult to get property into super under the new bring forward rules. There's also a modification of the bring forward rule for those members who have super balances between 1.4 million and less than 1.6. So there's a table there in the slides. I'll let you have a look at that in your own time.